Hi, everybody. I'm Jaden Doye, and I'm delighted that you've joined me for this episode of the Long Quarter Podcast. I'm known as the Traveling CPA, and I've dedicated my professional life to helping firm owners reach new heights and catch more flights. I believe that you don't have to be tied to a desk 7 days a week to have a profitable firm. That's why I'm here, bringing ideas and information that can help you create a first-class firm that pays you the salary you deserve and provides you with the lifestyle you desire. In this episode, I will talk about the core financial statements that every law firm owner should be aware of and should view on a monthly basis. The core three financial statements are the income statement, the balance sheet, and the cash flow statement, also known as the statement of cash flows. So let's first talk about the balance sheet. The balance sheet shows the company's assets, liabilities, and equity at a certain point in time. So at the top, you'll see the asset section. This starts with the cash and cash equivalents, and it will show the balance in ending cash at the time of the statement. So, for example, let's say your balance sheet is dated for 12/31, so December 31st. It will show how much cash you had on December 31st. Then under the assets, you'll see liabilities. This shows what you owe other people. Typical liabilities will include your credit cards, maybe a car note, things of that nature. And last but not least, you'll see your equity account. This shows how much equity you have, or if you have other shareholders, how much equity all of the shareholders have in the business. Now, the key features of the balance sheet is that it shows the financial position of a business. It shows a snapshot of the financial picture of the company at a specific point in time. Now, remember this equation: assets equals liability plus shareholders' equity. So, in business, when you're looking at your balance sheet, things that you want to be aware of is, are my assets higher than my liabilities? A healthy business will have higher assets than liabilities. If you only have $2,000 in the bank, but you have debts of over $200,000, when it comes to lending, companies will not look at your business as a healthy business. So there are some points in time to which maybe you just acquired a business loan. So there are periods of time to which your liabilities will be higher, much higher than your assets. However, that should not be normal. You should not consider that to be normal during all the time that you're in business. Certain periods of time, it does make sense, but it should not be the norm. Next, let's unpack the income statement. The income statement starts at the top with your income accounts. So it will show things such as your legal fee income, reimbursable income. If you have products that you sell, product income. Then it shows cost of goods or cost of service. So if you have products, then the cost of those products will be there. And if your accountant considers your labor cost to be a cost of service, then your labor will go directly into there as well. Hey, it's Jaden here, taking a quick break. Thanks for listening this far. I just wanted to let you know about the Law Firm Growth Toolkit I've put together. You can actually download it now at www.lawandquarter.com. This toolkit will provide you with the resources needed to start making strides towards creating the firm of your dreams. Once you subtract your gross income from your cost of goods or cost of service, you have what's called a gross profit. From there, next is shown the operating expenses. The operating expenses are deducted from your gross profit, and this gives you the bottom line, aka net income. So, some key features that you should be aware of the income statement is that it shows your revenue and expenses of your business over a period of time. So you could show this statement for a year, a quarter, a month. There's so many different periods to which you can show your income statement. But you want to view your income statement as you go throughout the year. You want to have your income statement where it shows every month next to each other so that you can view where things are going. Is the trend where income is going up, or is the trend where income is going down? Are there certain expenses that seem to be more sporadic? Are there certain expenses that seem to be too high as compared to your income? Are your expenses and income in line with the projections and the budget that you set forth? All of those things are things that you need to think about. Now, your income statement, this is what is used to assess your profitability. And that's why we're all here, right? To increase our profits. To increase your profits, you first have to know where your business stands as far as profitability. And to do so, you'll need to examine your income statement every month. Now let's move on to the cash flow statement. The cash flow statement is used to answer that question, well, where did all my money go? Have you ever, at the end of the month, said to yourself, man, I know money came in and money went out, but where did it go? Why is my bank statement barely any different at the end of this month than it was at the end of last month? Well, the statement of cash flow will show you the increase and decrease in cash over a certain period of time. So it has 3 sections: cash from operations, cash used in investing, and then cash from financing. So it starts out with your beginning cash, and then what's either added or subtracted is your cash from operations, aka your net income. And then what's shown is the cash that was either used or that came in from investing and financing activities. So if you used credit cards, or if you got a loan, or if the owner contributed money to the business, or if the owner took out distribution, all of that will show on your cash flow statement, and that will reconcile it. So believe it or not, it is possible for your bank balance to barely move from month to month, but for you to still show a net income. So when people say, I wasn't even able to pay myself. I don't see how I had a profit this month. Well, you took a lot of cash and you put it towards those loans that you signed up for. So you personally didn't see any of the cash, but it was there. You did generate a profit and it went to pay off a loan, which is why it's so important to be very strategic when you borrow money for your business. A good software like Cosmolex or QuickBooks will be able to provide you with the financial statements that you need in order to view from month to month and assess the health of your business. Well, oftentimes people want to go with the cheapest accountant, and there's a reason why certain accountants are cheap. It's because they don't know what they're doing. So oftentimes when I look at financial statements, I see improper categorization. So for example, when you pay a car note, okay, you don't create an account called car note expense. The payment goes to reduce the liability. And actually a portion of that payment may be expensed as in the form of interest expense, but you would not create an expense account to pay off a liability. That is the number one mistake that I see on financial statements. Another mistake that I see is not that the bank account has not been reconciled. So every month at the end of the month, a part of the accounting process is that the bank account is reconciled in the accounting system to verify that everything that is in the accounting system matches what is on the bank statement. Sometimes there's certain activity that you don't see until the reconciliation process. And those can include bank fees, interest that was put on the bank account, and uncleared checks. All of that is handled during the reconciliation process. And oftentimes people will go the whole year without reconciling. And then when they try to reconcile at the end of the year, they see that there's a difference. And they just throw the difference over to what's called reconciliation discrepancies. It's an expense account in QuickBooks. And I have seen some large balances and reconciliation discrepancies that should never be used. And if the bank account has not been reconciled, that means that all the activity is not correct. Therefore, you have improper financial statements. Therefore, you cannot make data-driven decisions. So this is why every step of the process has to be done correctly. This really speaks to the importance of having the right person processing the bookkeeping for your firm. Thanks so much for listening to the Law and Quarter podcast. I hope you enjoyed this episode. Please visit our website at www.lawandquarter.com for more show notes and additional episodes. If you have time, subscribe to the podcast and please consider rating and reviewing the show. That will help other people find us. Again, thanks for listening. We'll catch you next time on the Law and Quarter podcast.